Hello, and welcome to another edition of 9 to 5 Live. This morning's subject is, should we sell in May and go away? And here to tell us about that and lots of other things is Francois Savary. Hello, Francois.
Hello, Mark.
Thank you for joining us. First of all, do you believe in the folklore that one should sell in May and go away?
I don't think so. I think this is the kind of rule that I don't follow, and I am not particularly convinced by this idea. Nevertheless, you have some numbers that prove if you look over time, that at some period this is working. I think that what matters at the end of the day when we consider the market development, especially on the equity market, since the beginning of the year, is this strong rally on equity market sustainable in the medium term, considering the development that we experienced over the last few months.
What could derail the stock markets? It's taking everything in its stride. Bond yields are creeping back up to 475, and there's some confusion about the next move from the Fed on interest rates as well.
I agree, but the problem or the issue is that at the end of the day, the market has been able to digest quite well the fact that the interest rates are not going to come down the way it was expected at the end of 23. At the end of the day, when you look at current market expectation for rate cuts, they are nearly zero until the end of the year. It's one rate cut maybe. So you can see that the market has adapted to such a scenario. It partly explain why you had such volatility in April, and it explained why you saw the market nearly falling 5% in the US and recover quite strongly last week. The main reason behind the rally is the fact that earnings are delivering, and the key issue for the coming months is the fact that we need to see earning per share deliver. Otherwise, there will be a problem, because then if earning per share do not deliver, the issue will be the issue of growth. Is growth still high enough in the US? And that's the key issue for the coming months.
Were you surprised about the results from Microsoft? And do you think that's a pointer to tech and the economy at the moment and what's driving the stock markets at the moment?
It's clear. It's clear that the artificial intelligence is a key issue and a major development. And what is very, very important is that the companies that are reporting, when you look at Google or Microsoft or even Nvidia, which will deliver its result later, what you see is that really those companies are benefited from the fact that all companies need to build the infrastructure to have artificial intelligence as a strong element in the strategy of companies. It means that those companies are benefiting from that, from the clouds, from the chips, and etc. Then will be the issue, how do you monetize these artificial intelligence in the other companies who are purchasing those infrastructure, how it will materialize in the medium to long term? This remains a key questions that we need to take a look at.
Coming to the week ahead, there's a lot of important economic numbers being released this week. What are you most looking forward to?
First, I will look at what is happening with the Fed. What will be the message of the Fed? Going back to your first question about interest rates, it's going to be very interesting to see how Mr. Powell is going to come out of the meeting and how he's going to express a new view in terms of what he foresees in terms of inflation and the ability to lower interest rates. This is going to be a message that is going to be very significant. The second element I will look is two stocks from the big techs which are reporting this week. I will take a look at what is happening with Amazon. Does it benefit also from the cloud? And there will be Apple. Apple is a company that needs to go through a turnaround. They need to adjust their strategy. They are facing some kind of disappointment from market participants because the recent numbers and the recent news were not particularly good. So those two things are very important. And then you have, again, you are coming back to China because we will have the PMI coming out of China this week. This is a key element because we all know the importance of this market in terms of development for the financial asset in general. There is two elements that I would like to mention also. They are political. First, what will happen today in Spain? Will Mr. Sanchez going to stay? Is he going to stay or is he going to leave? Is he playing a game? We all know that Mr. Sanchez is a very good tactician. And then there is another issue that we need to look at. There is a by-election in the UK. You have a lot of pressure on Sunak. You have some member of the Tories who would like to go for something, a challenge, and because the prospect for the Tory party in the UK in the coming election are not very good. So I would take a look at that very closely.
Correct me if I'm wrong, but I noticed the PMI in the US, for a change, not in China, is in negative territory at the moment. It's expected at at below 50. Are you surprised about that?
Not necessarily, I never purchased the idea that there would be no soft landing or no landing in the US. I think that there was a point this year where people were pricing the fact that no landing was the big scenario. The recent GDP numbers proved you that maybe it was too much to expect such development. There needs to be a slowdown in the US economy. I'm not so much worried by the fact that it's below 50. It tells you that there is some slowdown, which is at the end of the day something that is good for inflation development. So no, I'm not too worried. Coming back to the GDP number that were published last week, people made a big thing about the numbers, which was at 1.6%. It was below expectation of 2.5%. So was it the end of the economic growth in the US? Absolutely not. You had some special elements that explain, first of all, the budget deficit, which is now less of a problem in terms of growth, because we all know that the US overspent. So now they are reducing the spending, so it is impacting. And second, you have inventories developments, and the inventory development subtracted from growth. But real final demand remain quite strong in the US. It means that you should not be too worried.
Finally, we can't really leave this morning without talking about the yen and some extraordinary events this morning. So the yen touched 160 against the dollar. Um, can you explain to us the situation the Bank of Japan finds itself in, and why is it so difficult for the Bank of Japan to find a solution to weakening yen? Although maybe it just doesn't want to.
Not sure. The big question, the big issue is, at the end of the day, it's the strength of the US dollar. The strength of the US dollar is posing major problem to different countries for different reasons. Emerging market, Europe, Japan. Japan is in a situation where they try to get out of their very, very loose monetary policy, which was in place for more than 20 years. The big problem is they have some concern about one key issue. Is Japan really out of deflation? That's a key question. We had some numbers that are telling that you have inflationary pressures coming into Japan, but they are limited. So what the Bank of Japan wants to have is more visibility on the inflation prospect medium term, and that's key. It's medium term, except from some short-term developments, in order to define if they can raise interest rates one more time, two more times, twice in the coming month. So for them, that's the big issue. They don't want to put at risk the fact that the economy seems to be now normalizing with an interest rate hike that could weigh too much on their economic growth in the medium term. So that's the key issue. It's the divergence of cycle, and the divergence particularly of monetary cycle between the US and Japan that is posing a problem to Bank of Japan.
Very quickly, the after the yen touched 160 against the dollar, it pulled back all the way back down to 155 something. Were you surprised about the violence of that move? And do you think that shows that the Bank of Japan has been, or someone else, has been intervening in the markets?
I think that there could be all the elements for something like that, because 160 was a hurdle, a significant hurdle not touched since 1990. So it's a key element and a key level for the Bank of Japan. Today is a holiday in Japan, so there is reduced liquidity. At least it's a warning sign that the bet against the Japanese currency is under threat of intervention. Was there intervention or was there not? I think that very quickly we will know that and we will understand that. I would not be surprised if we learned that there was some kind of intervention between these moves, because this is a huge and significant move.
Francois, thank you very much indeed. That's all we've got time for. See you next Monday. Bye-bye.
Bye-bye.